Hello everyone, this is Andrew McNair from SWAN Capital with our October 2021 SWAN report. Let's discuss what is happening in the market and how it may affect you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, at SWAN Capital, our market outlook remains positive, but we're keeping a close eye on inflation as well as the debt ceiling conversation. The third quarter of 2021 is already behind us, and the consumer confidence did start to slide in September. And the index actually dropped from 115 to 109 on September 28th. And this is one of the major contributors to the market's pain that we saw at the end of September. And the consumer's declining attitude towards spending is actually partially due to our current economic condition, especially the concerns about inflation. And a government shutdown was narrowly avoided as Congress reached a last-minute agreement to fund the government into early December. That national emergency is temporarily averted, but the debt ceiling conversation is not over. It will still need to be addressed again in December. And the markets rallied on this news, erasing most of the previous week's losses amid more volatility than we've seen recently. But let's go back in history to get a perspective of this debt ceiling. See, when Ronald Reagan left office in 1988, the national debt was only at 2.7 trillion. Now it's close to almost 30 trillion, and that's before the potential new spending bills. The debt ceiling was at 22 trillion just as recently as 2019, and now we're asking to raise it again. So the debt ceiling conversation can get really academic and hard to follow because we're talking trillions of dollars. But here's a simplified way to make sense of the situation. Let's say the debt ceiling is your credit card limit and the national debt is your actual balance on your credit card. If you have a positive difference between the limit and the balance, you have available credit that you can spend. But right now, the US government has zero available credit. Zero available credit. And if you as an individual or your family hit or exceeded your credit card limit, your bank most likely won't call you to ask if you want your limit raised. No, instead they're going to call you and say, hey, you need to make a payment ASAP and start making a dent in this balance. But not the US government. We just keep on printing more and more. And we take this risk every time we as a country borrow and spend up to our limit, only to get maxed out and go through the process over again. So at what level will creditors stop funding or really rating the United States government if we continually raise this debt ceiling? Now, it's a perfect time to turn our attention to the Fed. The usually low-key and reserved Federal Reserve had an interesting month. Two officials resigned, citing reasons from health concerns, not to becoming a distraction. Whatever the reasons, Eric of Boston and Robert Kaplan of Dallas left in the wake of being caught in a trading scandal and violating the Fed's rules on investments. Again, it's very scary times where the Fed's potential people at power are selling and buying before they even know news that they're going to give to us as the people. Scary times. So Fed Jerome Powell originally said that inflation was transitory. Now he calls the current situation frustrating. And that seems to be an understatement. We've said it before here that inflation was real and not a blimp, and it would cause pain for us. However, now inflation is running at 30-year highs by some measures, and now he finally says it's frustrating. One troubling news for this month is the labor market. After the ADP report came in slightly better than expected, which is basically the jobs versus the consensus of hopes of how many jobs there would be, we saw that the jobs report was not as comforting as we hoped. And we hoped that the September jobs report reading would be robust with all these kids back in school, extending unemployment and rent moratorium programs ending, and an eye-popping 11 million openings. Sadly, with those expectations, they were only in the 500,000 range, and the anemic 194,000 actual number fell flat again. So we're keeping a close eye on this jobs market. And they continue to blame the primary reason for this jobs market being the Delta variant was peaking when this report was compiled. But the participation rate, which counts the people actively looking for work, declined, as did the level of discouraged workers. In a rising labor market, the participation rate should be going up, and the discouraged number should be declining as those people get more active in their search for employment. So it's really a mixed bag with the jobs report. But perhaps people who wanted to work got back to work, and those who didn't fell off the radar since they aren't collecting unemployment or any additional measurable benefits. So one concerning trend of note is that the wages continue to rise to the tune of 4.6%, which is really close to the inflation numbers that we're seeing. So fewer available workers demand higher wages and also boost prices, either through production capacity constraints or leading to the inability to produce more to satisfy the demand. So again, with higher wages, increased costs for the average consumer. Back to the Federal Reserve. They are watching this job situation closely, and it is recently indicated that the Fed is starting to pull back on some of the liquidity provided during the pandemic, primarily because inflation has already exceeded the Fed's 2% goal. But with the Fed still tapering, with the 2 months of weak jobs growth, will they continue? Markets need to digest all of these details, which may only lead to more uncertainty and more volatility. With jobs stalling, it's really going to be interesting to see how the jobs market combined with inflation leaves the Fed wondering what to do. It puts them in a bad place. Do they raise rates to stop inflation and potentially kill economic growth? Or do they leave rates alone and inflation starts to affect the average consumer? That's going to be it for this month's SWAN report. I want to thank you for listening every month, and I look forward to seeing you next month. Have a great week.